All right, a lot of questions out there. What are the changes to the MassHousing program? And in this video, that's what we're going to cover. So last week, mid-February 2024, announcement came out that MassHousing had made changes. Now, those changes do not take effect until March 18th. We'll talk about that here as we go on, but they don't technically take effect until March 18th, 2024. But here's a breakdown. Now, most people have come out and been like, oh, yay, the down payment assistance amounts have gone up, right? So that's absolutely 100% true. There are two main programs to MassHousing. The first program is the Workforce Advantage program, and the second program is the First-Time Homebuyer program. Now, there are other programs as well, but those are the two that primarily are going to be used, is Workforce Advantage and then the First-Time Homebuyer Massachusetts MassHousing program. So the Workforce Advantage used to be 10% of the purchase price up to $25,000. That now is $30,000, and not now up to $30,000. It's just $30,000. So if somebody's buying, say, a $250,000 house, they could get up to $30,000, not 10% of the purchase price anymore. They can just get up to that $30,000 figure. On the standard first-time homebuyer program, it used to be 5% of the purchase price up to $15,000. That number is now $25,000, and again, not a percentage anymore. It's just a flat $25,000 they can get. So in the past, if somebody was buying, say, a $200,000 home on that program, they could get $10,000. If they were buying a $300,000 home, they could get $15,000. Now they can actually get $25,000 on the standard MassHousing program. So there's the major change that everybody's talking about. The impact of this is actually much larger. So I gained some notes here, so I'm going to pull these things up here as I'm reading, so you see me looking down. Sorry, that's what I'm doing. I want to make sure I'm catching everything for you. But what else has changed here? Well, lower credit scores now are in play. Higher purchase prices are now in play, and higher debt loads are now in play. Now, people are going to look at the guidelines. They're going to say, well, wait a second. No, the old guidelines said you could have a 640 credit score, and the new guidelines say you can have a 640 credit score as well. And so the guidelines didn't actually change, but the changes to the program, actually, the impact of them will allow people with lower credit scores to get a loan as opposed to people in the past that couldn't. Now, let me explain that a little bit. So let's say in the past, even though the score said 640 for MassHousing, in the past, I always said 680 was about where you needed to be for your credit score in order to get financing, because there's an automated underwriting system in the background that looks at buyers and says, okay, here's checks in the positive column, here's checks in the negative column, and it gives us an approval or denial based upon those good and bad checks. That's what the automated underwriting system does. So in the past, with the amounts that were available before, your loan to value had to be a little bit higher, and you needed about a 680 to get approved on a conventional loan with just, say, 3% down. Here's an example of that scenario. $300,000, old program, the max you could get was $15,000. So if somebody didn't have any money to put into it themselves, they needed to do 3% down. I would take that $15,000, apply 9 of it to the down payment, and I'd apply 6 of it to their closing costs. Let's just assume closing costs plus taxes, insurance, everything all combined. Let's say it was $10,000 to keep our math real simple here. That person then needed an extra $4,000 to buy that house. 9 for the down payment. An extra 6 was coming from the $15,000 that was coming from the program that would go towards those costs, and then they need to come in with another $4,000 themselves. Now, that person buying that $300,000 house, they now can put a full 15 down on that $300,000 house. That's a full 5%, and they still have $10,000 left over for closing costs. So now that person who maybe needed a 680 to do that 3% down program, when you're looking at those plus and minus columns, now you're probably getting approved somewhere around the 660 mark on the conventional loan 5% down, 10% now going towards those closing costs, and you're in essence walking into that house with no money out of pocket. So that is where lower credit scores come into play. And an even larger impact that's allowing people with lower credit scores to buy a home is that MassHousing brought back their FHA product. Now, that FHA product used to be around pre-2020, but then it went away. It is now back again. A lot of people qualified with MassHousing FHA pre-2020 that all of a sudden were cut out of the market post-2020 because that program went away. That program now with FHA has come back. So if you're out there, realtors, you're looking at offers, most of you think that MassHousing is just a conventional loan. It's not just a conventional loan. It is FHA as well. The Workforce Advantage, we said there's two programs. There's Workforce Advantage and there's the standard first-time homebuyer program. The Workforce Advantage always had the FHA. However, generally speaking, people would be placed in the conventional if they could. Same thing now. We're going to try to pace people into conventional because that's what sellers are preferring right now, and that's making offers more competitive. However, the FHA being back now means somebody with a 640 credit score can very likely get approved now for the program with very little to no money out of pocket. That was not available before with the lower amounts and without the lower amount of down payment assistance and without having the FHA product. FHA product has opened up a whole another group of people who are going to be able to buy now with this program because lower credit scores for FHA are still acceptable. FHA, great program. Obviously, sellers don't like it quite as much because they feel they're going to have to do all kinds of work to their house. That is really a misconception. There's not that much that needs to be done to houses for it to meet the government financing requirements, but I don't know. We've still got this old school form of thinking out there that says there is, so sellers still are shy away from it, and therefore conventional tends to win out on those offers. So lower credit scores, higher purchase prices as well. So let's give an example of in the past. Say you were buying a house for $400,000. In the past, your minimum down payment was, say, 3%. On that $400,000 house, 3% would be $12,000. And on the standard program, the max that you were going to be able to get for down payment assistance was $15,000. So 12 of it would go to down payment. There was only 3 left over to go towards closing costs and everything. Now, if 12 goes towards down payment, you've got plenty of money to cover all of your closing costs. So now somebody who didn't have the money to get up to $400,000 because they were short cash to close, that extra money has now enabled them to go higher, and higher debt loads allowed as well is a major impact of this MassHousing program because now we've got more money to work with. We could use this money instead of a borrower coming out of their pocket with their own funds. I can use their own funds to pay off their debt. I can use some of the down payment assistance funds to purchase what's called a single premium mortgage insurance policy, which is a program that does not have monthly mortgage insurance. You're paying for it up front and you don't have a monthly mortgage insurance expense. And because the down payment assistance is so much higher now, there's extra money in there to be able to do that. So we'd able to increase purchase prices, increase that debt load a little bit on this new program, even though the debt to income ratios didn't change. It's still at 45. Doing this and having more money to work with now puts us in a position to where we can play around a little bit with that money. We can buy down interest rates with permanent rate buy downs. We could purchase single premium mortgage insurance to get out of any monthly mortgage insurance premium. Lots and lots of different options, okay? So the changes, just the dollar amounts, that's not all the changes, right? $25,000 and $30,000, that's not all the changes. The impact of those changes, it just reverberates through the whole thing to where it creates an entirely new and larger group of people who are going to qualify, who are going to qualify for this loan. So let's go over just the programs just in general. So to review the programs, the Workforce Advantage is $30,000 now as of March 18th. By the way, let's talk about that March 18th date. most lenders, I would assume, are going to try to copy what we're doing, which is we will start underwriting under the new guidelines and close after the 18th. The downside is MassHousing will not let us register or lock those interest rates in until March 18th. So if you are setting up a closing, you should be doing so for end of March so that your file can be underwritten to new guidelines. It can be locked and registered on March 18th and then close after March 18th under the new guidelines. You will not be able to close under the new guidelines before then. So the March 18th date is an important date there. So anyway, the two programs, Workforce Advantage, $30,000. The main difference between Workforce Advantage and the standard first-time homebuyer program are income limits. Workforce Advantage, far more strict. It is considered a low to medium income buyer. There are two programs there. There's a conventional program and there's an FHA program. That conventional program has no monthly mortgage insurance, which is awesome. Saves you a ton of money. And the $30,000 comes at a 0% interest rate with no payments. You don't pay that off until you've finished paying off your loan, you've sold your house, or you want to refinance at some point. At that point, you'd have to pay that off. Now, some people say, well, that $30,000, I've got to pay that off. That's going to keep me from refinancing. That's not true whatsoever. First of all, when you take a look at your blended rate, that $30,000 is at a 0% interest rate with no payment whatsoever. Okay. If you take a look at your blended rate, your first mortgage, let's say it's at, I'm just going to throw out an even number. Let's say it was at 6% right now. Okay. They're actually a little higher than that rate, but let's say it was at 6%. When you take a blended rate of your first mortgage and your 0% interest rate mortgage, your rate is well under that 6% mark. It might be closer to 4.5 or so when you take a blended rate and you consider the fact that you're paying no interest on that $30,000. The second piece to that is I've heard people say, "Oh, that's it's a loan on the house. That's horrible. You have to, you can't ever refinance." That's again just a total fallacy that you can't refinance. Let's say you're buying a house. Just an example here. You're buying a house and you need a loan for $100,000. Okay, you get $100,000. If you go to refinance that loan in 3 to 4 years, maybe it's 5 years, whatever the time period is, you go to refinance that house down the road, what happens? You've got to pay off the $100,000 or whatever balance is left of that $100,000 because you've been paying down on that $100,000. Well, the same thing happens here. Instead of borrowing $100,000 though at say a 6% rate, you're borrowing $70,000 at a 6% rate and you're borrowing $30,000 at zero interest with zero payments, right? When you go to refinance, you're just going to pay off whatever's left. And you've started to pay down that 70, and just like you started at 100 and maybe you're down to 90 owed by the time you refinance, well, you're still starting at 100 and that 70 maybe is down to 60 and the 60 plus the 30 is still 90. So you're still paying off the same amount. The argument that you can't refinance or that it's going to somehow impede you in the future is just usually an argument of people who either don't know the program or don't offer the program. So Workforce Advantage, $30,000, 0% interest rate, zero payment. All right. They also have an FHA program. The conventional also has no monthly mortgage insurance. So that's a huge savings. No monthly mortgage insurance payments in there either. The FHA version, still getting your $30,000, but FHA has mortgage insurance. There's no way to get out of that. The standard program, $25,000, has a conventional version. It's got mortgage insurance. However, you can buy yourself a single premium to get rid of the monthly mortgage insurance using that $25,000. There's a lot more options now because you have more money. The FHA version, again, just opening up some lower credit scores. A couple other changes here. I'll read through some of them here. We have On the Workforce Advantage program, it used to be only 1 and 2 family unit or 1 and 2 unit properties. It's now 1 to 4 unit properties, including condos and PUDs. We have the FHA version also 1 to 4 units. We have the first time home buyer program. Again, used to be just the 5% of the purchase price up to 15. Now it's up to the 25. And the gateway cities are kind of a little bit less important. Prior to this, there were some gateway cities that could receive additional funds or additional program incentives, I should say. Now that's kind of somewhat been erased. There are some gateway city advantages, but not to the 2 main programs that you're using, which is the first time home buyer program and the Workforce Advantage program. So there's some of the changes there. You're opening up basically for more properties. You're opening up 3 and 4 unit properties. By the way, FHA also is going to help with those multifamilies because the conventional financing does require larger reserves than FHA does on multifamilies, and therefore FHA is going to help you on those multis as well. So that's just kind of a rundown of the changes. Yeah, the 15,000. I keep hitting this thing. It's in my way. I'm Italian. I talk with my hands. Yeah, the 15,000 turning into 25 and the 25 turning into 30,000 is huge, without a doubt. But the effect of that reverberates down into who's now going to be able to get approved, that made a much larger difference. So if you had been denied for a loan in the past because you didn't have enough funds to close, now's a time to talk again. And I'd be happy to talk to you, but to talk again about the MassHousing program, because many people who were unable to get a loan are now in a position to, in fact, get approved for MassHousing with these additional funds and additional programs that came into play. So that's it. There's the skinny on the new MassHousing changes. If you've got any questions, please feel free to hit me up, shoot me a message. I don't know, hit my DMs, comment, like, share, subscribe, all that good stuff. I'm here for you for any of those MassHousing questions that you might have. Have a good one.